bring in Lakshman Achuthan and find out why he was right about getting jobs in a better economy right. You really nailed this with your indicators, didn't you?
The indicators nailed it.
The indicators.
I'm just the messenger.
What do they say now for the future?
Well, there's no new recession. The revival is intact for the economy, but I do have a turning point ahead. Okay, and it's a peak. It's a peak in global industrial growth, a long leading indicator of the global industrial sector.
Which has been on a tear.
Which has been on a tear. So last year, just to put this in perspective, last year everybody's going double dip.
Right.
We held off partly because this long leading indicator of the long leading indicator of global growth was turning up really strong. Right. Now you're seeing that. You look at the commodities, you look at all these things, everything's running up. Manufacturing's been doing well. The economy's in a revival. All of these things, but we're looking forward, as you were saying in the lead-in. Okay, this is what's going on now, but let's look out the windshield. Let's look forward, and we see unambiguously a downturn in the growth rate of industrial activity by this summer. Globally, no one will be left untouched by this. The U.S. will participate, China will participate, Germany will participate.
What does that do to GDP? Are you not calling recession?
No, but markets care about rates of growth. They care about accelerations and decelerations.
First derivatives and second derivatives.
And they freak out when the growth rate slows down, as you saw last year, right? Everybody remembers last year, right? It's not that long ago. And here we have a downturn in global industrial activity that's going to start this summer. So short leading indicators, which include commodity price inflation, those things are going to turn down ahead of that. And I wouldn't buy into the idea that demand for all these commodities is going to save the day. It's going the other way.
Dreaded first chart. Wages is the theme today. Here it is. Once again, negative wage growth. I'm fascinated to ask you this because this is different. What you do with cycle research is very different than a more extrapolative forecasting. What does it say about wages? We have there, look at that chart. This is the inflation-adjusted old average hourly earnings survey. Very production, very blue collar, if you will. And I say that with respect. And we've dipped negative with that higher inflation. What does your survey say about wages?
Well, look, you've got a fundamental problem in the jobs market. We all know that. And so when you look at these aggregate numbers, you've got a huge segment which is struggling to find work, and that's holding down wages. You see that. And also you have globalization, which is holding down wages in the West. The structural shift, which is holding down wages in the West, which is not over. So that's all contributing to this. I think in certain pockets of the labor market, you have actual wage inflation. But that's few and far between. You have to have the right skills. If you're in information technology, you're finance, accounting, engineer, you can get a raise.
Bring up the same view, nominal average hourly earnings. This is the top line, and this is the old series going back. It's about a 2% right now, and you can see that rollover over there on the right side. And then we're going into your headwinds. This is break-exclusive news, folks. Lakshman's going a little more cautious here as we go into 2011. Is there any hope of getting the actual wage up, even if inflation stabilizes?
Yes, there is. But what it requires is a longer expansion. You have to, it's duration of expansion which is going to help fix this and repair that. It's not pace of expansion. And I think so often the focus is on pace. We must go faster, we must go faster. That's not right. You need to have a long run like you had in the 90s or like you had in the 80s, and then that'll help with these numbers.
I want to bring up a Jim Glassman note here. Here it is, folks. He was on Bloomberg Surveillance this morning. Great effort. What a great show that was this morning. Radio Worldwide. Sirius XM, new channel 113. I don't know why they did that. They just moved our channel. I don't know.
I found you.
Did you find us?
I found it yesterday.
Thank you. High five right there. All right, Lakshman. That was a massive shameless plug. Anyways, here's a note here from J.P. Morgan Chase. Though very nice graphic there. Ken is so much better looking than me. There is no volcanic pressure building if wide swings in commodity prices are barely visible at the retail level. It is because materials represent tiny part. Do we have inflation or not?
You know what? Look, our future inflation gauge has been edging up, so there's no deflation. That's since last summer. It's been edging up. Today, this morning, it came out. It fell 2 points. okay, in spite of the higher commodity prices.
Right.
And that goes into the JOC index, which goes into our future inflation gauge. If it was so simple, right, that if you could look at the commodity price and then forecast inflation, everybody would be great at forecasting inflation. And obviously, everybody's horrible at forecasting inflation, right? They're not. People have a tough time doing it.
It's a tough job.
And there's a lot of other drivers. Wages are a driver. Currencies are a driver. Bottlenecks in the system are a driver. These are all different drivers. You need to see what they do collectively, right, in order to get the direction right.
Here's where we are. Der Spiegel is saying, and I have to be very careful here. This is from Peter Bukvar, a quote secret crisis meeting, unquote, in Luxembourg to deal with a threat from Greece. They are thinking about withdrawing from the Eurozone. I'm going to suggest some of what I just said probably got lost in translation. And again, we've got Juncker denying the Der Spiegel report. So this is very fluid. I don't want anybody trading off what we're talking about, particularly because we're with Lakshman Achuthan and Nariman Behravesh. Nariman Behravesh of IHS. Let me go to you first, Nariman. No one has really talked seriously about Greece leaving. Does it sound preposterous to you?
Well, no, it doesn't sound totally preposterous. I mean, I have to say the advantage to Greece is, of course, it can let its currency go if it adopts and can adopt. It's a very complicated process. The drachma, again, which is its old currency. But the other problem is, of course, interest rates in Greece would skyrocket. And so it's not clear that this buys Greece very much. I think my guess is they're using this as a political leverage, as blackmail, if you want to call it. If it's happening, that's what's going on.
Are we anywhere near restructuring? I know you follow this seriously with all your European clients. Are we near a restructuring, or are we just jawboning? Jacques Caillou today talked about the ECOFIN meetings of May 16 and 17 being important. Are we near one?
No, I don't think we're going to go all that far. And as we were just hearing, there's a lot of benefit to being in the Eurozone with the lower interest rates. But I think Europe is going to be a big focus this summer, not only because of this, but because of Spain, where Spain never left recession. They're in the fourth year of their recession. However, everybody's pretending that somehow they're slightly expanding and they're in a recovery when they're not. And as that wears thin, this kind of pressure really builds, and basically Germany and France have to get together and continue the bailout.
Nariman, I saw you at Davos. We were surrounded by hope. Everywhere you went in Davos, it was hope, 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 hope. Well, here we are in May, and these headlines still shake the market with euro-dollar weakening further, 144.34. What is your prediction for what we will see in Europe this May?
Well, I think there's no choice in the case of Greece. We can talk about the other countries as well. There's no choice about restructuring. They're going to have to do it. Greece is bankrupt. So, we can talk about how much they're going to have to take down the principal, but they're going to have to do something. And there are models out there. Latin America in the 1980s provides a very good model of how Greece and Europe can work their way through this. But they got to do it. I don't think there's a choice here.
I mean, it just continues to we just continue to run into this. Nariman, have you figured out the fiscal drag yet to the peripheral countries from all these goings on? I mean, are they in recession now?
Oh, there's no question about that. I mean, it's huge. The sort of the north-south divide in Europe, and Ireland falls into that category as well in terms of the troubled economies. But those countries, on average, growing less than 0.5%. Some in deep recession. I mean, Greece, we're talking many, many years of negative growth. Spain was just mentioned. On and on. Portugal. These countries are in deep economic trouble. And the fiscal contraction is a big part of that.
Let me summarize this again, folks. Der Spiegel talking in Germany in a report on their website about Greece. I got to be careful here. Thinking about leaving the Eurozone. They called some form of emergency meeting in Luxembourg. Juncker of the EU, their spokesman, denies the Spiegel report immediately. But you see the market reacting. And again, Lakshman, the market's in charge here. Every interview I've done this week says, I'm sorry, the market is leading the institutions. Do you buy that?
Yeah, well, I mean, in the institutions, what happens is when they can't forecast, they look at the markets and they say, well, the markets must know better about where things are headed. So we got this back and forth between them. But what strikes me is that if we're right about a global industrial downturn, And the shine is coming off of all this hope that there was just a month or so ago. That's a problem, right? The hope perhaps is that the global industrial downturn takes enough off the commodity price inflation that these banks don't have to be so aggressive in tightening. Right. That remains to be seen. When we look at our future inflation gauges internationally, they're still up. In the U.S., they fell 2 points. So in a weird way, the U.S. may be lucking out here.
Right. Yeah, and Lakshman, here's another headline, Nariman. Germany's Seibert denies EU talks on Greece leaving the euro.
Chip.
That was a phone call to our Bloomberg News team in Europe. Nariman, here's the crux of the matter to bring it back to jobs and try to synthesize this breaking news. An investment recovery needed. I'm looking at nominal investment in the United States as a part of GDP. And yeah, we've had a little bit of an investment recovery, but not much. What does the IHS Global Insight call on investment over the next 12 months?
Well, you have to break investment into its two components. Equipment investment, obviously, high tech doing very well and will continue to do pretty well. The real drag is, of course, construction, investment in buildings. That's still in the doldrums. Maybe we get some recovery this year, but it's still lagging. So when you put the two together, it doesn't look so good. But if you pull them apart, you can see that one's doing well, one's not.
Nariman, Lakshman was talking about a more cautious view for the summer of this year into third quarter of this year. Do you share that caution?
Well, I mean, I think the answer is yes, in the sense that we've had this very strong rebound in manufacturing. Manufacturing had a V-shaped recovery. You can't expect that to continue. So at some point, it slows down. That's not necessarily bad news. It's just in the nature of the beast. It's in the nature of a recovery. But we've come off very, very strong rebound. As I said, it's about the only part of the global economy that had a V-shaped recovery.
Bring up too much information, if you would, Rex. And Lakshman, I want you to jump in here with us to bring it back to jobs. Sure. David Rosenberg was brilliant today on this. We thank him for his appearances with me and with Betty Lou later. Rosenberg, housing impedes mobility. This is employment to population. This is a core, almost a sole statistic for the American economy. That is a frightening chart with employment to population back to 1985. What does cycle research say about almost a structural jobs recovery?
Look, you need time. The resounding response to that is that you have to have a longer expansion to heal that kind of damage. We had a small period of a housing bust in the early 90s. People were underwater. We had a similar type thing. Nothing of this magnitude. And then we had a 10-year expansion so we could heal it all. Okay,
and people could move
after
if they had to.
Once enough time went by, they were able to get closer to being underwater, out their head above water. They were able to get another job. They could make the move. The critical thing, every single thing that we are seeing in all of our cycle research is it's about duration. Slow and steady wins the race. You do not want to sprint. And when we have policies, here's the problem. You got policies, you're strapping a rocket ship on the back of all these economies with this liquidity. That doesn't that's a quick boost, that's volatility.
You and I could talk about that. We could do this all weekend. Lakshman, thank you so much. Nariman Behravesh with us from IHS Global Insight. Nariman, I want to play you a rewind here from Bill Gross this morning on Bloomberg Surveillance. I spoke with him, and I asked him if we're heading towards a Gilded Age.
Well, I think we're there, Tom, and we've been there for quite a while. This is a legitimate debate of capital versus labor, and it's true that capital is moving ahead quite smartly, but labor not so well.
And there's Bill Gross. I thought it was a great idea. It's a question that's been coming up a lot. I talked to Noah Rabini earlier about this at Milken. Let's talk to Nariman now about it. Nariman, just simply, is labor ever going to catch up?
Well, these are long cycles, Tom, and I think clearly capital has been doing well. I mean, there was the longest time when the profit share of GDP was falling, decades, and people worried about that. Then it turned around in the 80s and has been rising sort of since then. I suspect we'll peak out at some point, maybe in the coming decade, and we'll go through this sort of long cycle down again. Very, very typical pattern over long periods of time. So the answer is yes, labor will come back at some point, but it may take a little while longer.
Well, let's look at the wage of labor here. Let's bring up our note of the day. I thought this was a sharp note out of Toronto. And CIBC World Markets, Krishnan Rangaswamy, wages remain soft with hourly earnings up 0.1% in April, highlighting a potential risk to consumption spending going forward because workers' purchasing power is being squeezed. That sounded a lot like what Lakshman was talking about. Nariman, you seem to be more optimistic than Lakshman was.
Well, I think what's happening is a lot of people are focusing on commodity inflation, which is serious. But if you look at how much the typical household spends on food and fuel, it's about 15% of their budget. The remaining 85%, the inflation rate there is only about 1.5%. So the squeeze, while it's psychological, and I'm not saying it's not real, it's there, it's not a huge squeeze yet. We don't have pervasive inflation. So I'm a little less worried about sort of this kind of ongoing squeeze to consumers. Things are getting better. The employment situation is improving, as we saw today. So I think that's fairly positive for consumer spending.
What do you see this weekend? What are you focused on as you write research notes for Monday morning?
Well, I mean, the news that just came out about the euro is probably the thing that's going to dominate any discussions this weekend. It's, what are the options? What's happening? I mean, they may be able to avoid this crisis. Greece may be bluffing. But the problem is that Europe, the Eurozone, has major structural problems that they haven't begun to deal with. They haven't begun to deal with it. They're lurching from crisis to crisis. And I think they've got to stop and say, wait a minute, we got a problem here. I mean, just to kind of put it bluntly, look at the difference between Greece and California. Everybody sort of draws those parallels. California's got a lot of things going for it. If California goes bust, it still survives because of all the federal transfer payments, Social Security payments, all that kind of. Greece doesn't have that.
Well, we're going to leave it there. Nariman Behravesh, thank you so much.